but we're not getting anything for nothing. In fact, all of this extra inflation is going to damage the real economy. That is the ultimate irony of this, is that the Fed allowing money to lose value, allowing people's savings and wages to lose purchasing power is not good for the economy. It may be good for the stock market in keeping a bubble inflated and keeping prices high. It may be good for maintaining the illusion that we have economic growth because we're measuring that growth in nominal terms and not adjusting it for the decline in the value of money. But it's not good for the economy. In fact, one of the biggest ironies is that right now you actually have a lot of people in Congress who specifically want to charge the Federal Reserve with the added mandate of tackling the problems of wealth inequality, particularly racially based inequality, right? Where you have a large gap in the relative wealth of white and black Americans. And congressmen actually want the Federal Reserve to do something about this problem, to close the gap, the inequality gap. Now, how they're going to do that, especially along racial lines, they simply can't do that. But the other irony of it is one of the reasons that the income inequality gap is so large is because of current Fed policy. So in a way, the Federal Reserve could do something to close that gap by reversing the current policy that's helping to widen that gap, which is keeping interest rates artificially low and creating inflation. But now the congressmen who actually want the Fed to do something about making the gap narrower are now happy that they're about to pursue a policy that will widen it even further. Because the extra inflation that the Federal Reserve wants to create, it only helps the rich. How does it help them? Well, it pushes up the value of their assets. And when you are counting wealth, well, you're adding up assets. And so the wealthy are getting a lot wealthier as a result of these policies. Obviously, look at the super rich. Look at Elon Musk is now worth more than $100 billion, as is Mark Zuckerberg. Jeff Bezos now is worth more than $200 billion. And that's after he gave, I don't know how much, $40 billion to his ex-wife, McKinsey, who's probably worth more than $50 billion by now on her own. But all of the fortunes of the super rich are being inflated by the Fed. This bubble is causing all these stock prices to go up. And of course, not everybody is a multi-billionaire like these tech titans, but you do have a lot of Americans who have a lot of money in the stock market, and that is their wealth. And that wealth is now going to have a bigger number associated with it because of the inflation that the Federal Reserve is creating. But the problem is, at the bottom end of the spectrum, lower income people don't have any money in the stock market. They don't have any wealth. A lot of people at the lower income don't even own their homes. They're renting their homes. And inflation is going to put more upward pressure on rents. Their landlords are going to have to increase the rents they're charging to cover the higher costs that are going to be associated with the inflation that the Federal Reserve is creating. In fact, the cost of everything is going to be going up for people that don't own any assets and that are living paycheck to paycheck. The real value of their paychecks is going to be diminished by the inflation tax, as will the value of any savings that they happen to have. It's the debts of the rich that end up getting eradicated by inflation, and it's the assets of the poor, their savings, that get eviscerated. And so the rich get richer, the poor get poorer, and so this new policy of more inflation is going to exacerbate and widen the very wealth inequality gap that so many liberals are wanting the Fed to help close. And again, to show you how little people understand, it's the left that's actually the most vocal in pushing the Fed towards allowing more inflation, wanting more inflation, without even realizing that the inflation that they want is actually hurting the most the very people that they think is going to help. Because the Fed thinks that or not just the Fed, the liberals think that there's this Phillips curve, there's this trade-off between inflation and employment. And so they believe that when the Fed tries to limit inflation, that it ultimately limits employment opportunities, that people are thrown out of work by the Fed's fixation on keeping low inflation. And that if we just allow more inflation, that will allow more employment and a lower unemployment rate. And that is all BS. In fact, that is one of the other things that the media gets wrong when they are reporting on what the Fed is doing, as if it somehow relates to a rejection of the Phillips curve. The Phillips curve was always BS. It never made any sense. Inflation is not caused by people working. In fact, if you're going to define inflation as rising prices, if you're going to misdefine it like that, people working does not result in prices going up. It actually results in prices going down. Because if more people are working, then more stuff is being produced. You have more services and you have more goods. Well, as you increase the supply of goods and services, the price can come down. It's when people are not working and they're not producing that the supply of goods and services goes down, and that is when prices go up. So there was never really a link between employment and inflation. That link existed only in the minds of the Keynesian economists who signed on to it. And it should have been fully discredited during the 1970s, which surprised the hell out of all the Keynesians, because that doctrine existed before the 70s. And then all of a sudden we had stagflation, where we had a weak economy, we had rising unemployment and rising consumer prices, and that basically blew apart the Phillips curve. Right? And the Keynesians had no way of explaining what they were observing, because according to their models, it couldn't happen. But it did happen because their models were worthless. And so the Phillips curve has never been there. So it's not about the Fed finally rejecting it. It was disproven a long time ago. Inflation is not caused by people working. It's caused by the Fed printing money. Now, when the Fed prints money, sometimes consumer prices don't go up, especially if you're not measuring them properly. Sometimes it prevents consumer prices from going down. And sometimes inflation could be focused more on the price of financial assets like real estate, stocks, bonds, and things like that than it is on consumer goods, especially if you have other increases in efficiencies and productivity that are otherwise putting downward pressure on consumer prices, and that downward pressure is being somewhat ameliorated by the upward pressure being put on prices by the Fed. But if the market is putting more downward pressure on prices by improvements in efficiencies in production, then the upward pressure that the Fed is putting through creating inflation, then you can have the Fed creating inflation and you can have prices going down. But in the long run, all that inflation is ultimately going to result in a big spike in consumer prices, and that is exactly where we're headed. And the people who are going to be hurt most by the huge increase in the cost of living are going to be those that can least afford it. They're going to be the lower class, and then to a lesser extent, the middle class. And in fact, I think most of the middle class will be impoverished into the lower class as a result of the severity of the inflation that the Fed is unleashing. Not only that it is preparing to unleash in the future, but it has already unleashed in the past. It just hasn't caught up to us yet in the supermarket. It has in the stock market, but it will in the supermarket, and that's when it really starts to hurt. But the other problem that everybody is completely ignoring is what happens in the future once the inflation rate averages out to 2% or exceeds 2%, right? What happens if inflation gets hotter than the Fed is hoping for? Because after all, they're not perfect, right? They can't micromanage a precise inflation rate. And what if it turns out that by letting inflation run hot, it runs too hot, and the Fed now has to dial it back down, right? What if the inflation rate gets to a 3 or a 4% average? Now, again, as I've said, I know that no matter how high the average gets, they're going to keep on moving the goalposts. But everybody else doesn't know that. They actually believe the Fed. They think the Fed is serious about a 2% average. So they should be asking the question, well, what happens when the average goes above 2%? Because that's not going to stop on a dime. I mean, they're not going to be able to fine tune it that precisely. So what happens when we get too much of a good thing and inflation is 2.5%, 3% or whatever, and now the Fed has to bring it back down? How are they going to do that? Well, it is impossible to do that. The Fed is talking about a 5-year window. They're kind of saying, well, we don't think we'll have to raise rates for the next 5 years. Well, assuming they actually keep interest rates at zero for the next 5 years, and if Congress continues to borrow and spend over the next 5 years the way it's spending now, and of course, why wouldn't it? If the Fed is telling the government that they're going to monetize it, why wouldn't they take full advantage of that opportunity? After all, it's an opportunity to provide voters with a bunch of free stuff, and nobody wants to take away any of the free stuff that's already been promised, because then that gets defined as a cut. So if we continue to go on this borrowing and spending binge for the next 5 years, the national debt will be much, much bigger 5 years from now than it is today. And of course, it's not just the U.S. government that is going to be taking advantage of the Fed's largesse. You're going to have all of the corporations, right? They're going to be borrowing more money. American individuals are going to be borrowing more money. So everybody is going to take advantage of the Fed's commitment to not raise rates for 5 years and keep the monetary spigots open by borrowing as much as they possibly can and continuing to buy assets. And so the bubble that we have today, assuming it doesn't pop on its own, think of how much bigger it will be when the Fed is forced to prick it by now raising rates to contain the inflationary fire that it lit. It can't do it, right? Because the reason it has to allow more inflation today is because it can't raise rates now because we have too much debt. So in order to justify it's not raising rates now when the inflation rate is really at 2%, is to move the needle by allowing it to be higher so that they're not forced to do what they can't do, which is raise rates because we have too much debt to afford it. Well, if they can't raise rates now based on how much debt we have, how will they ever be able to do it in the future when we'll have much more debt than we have today? The answer is they can't. So for the people who are thinking clearly, what they know based on what the Fed just said is that rates are never going to go up no matter how high the rate of inflation is, that there is no target, average or otherwise. It doesn't matter. Whatever the inflation rate is, it's going to be that way. And it's going to keep getting higher and higher because there's absolutely nothing the Fed could do about it. Now, the Fed wants to pretend that it could do something. As I've been saying, when it comes to fighting inflation, the Fed is all bark and no bite. It has to pretend that it could do something that it can't do, so it's not forced to try to prove that it can do it and then show that it can't. So it always has to say, yes, there is going to be a point in time in the future where we're going to raise rates and fight inflation, but whenever it gets close to that point, it needs to move the bar like it's doing now so that it doesn't actually have to do what it's been bluffing it's going to do because it absolutely can't do it. But again, at some point, the market is going to call the Fed's bluff, and you're going to see that in the foreign exchange market. You're going to see it in the precious metals market. And finally, right, you'll see it in the bond market.